All right, welcome back to another Tech Talk from MarketEdge.com, your source for unbiased technical stock research. My name's Rachel, and with me today, as usual, is David Blake, CMT, here to discuss last week's happenings in the market and what we should look for as we go into this week's market. David, how are you today?
I'm doing well, thank you.
Great. Let's jump right in.
Okay, well, we had another volatile week in the markets, but this time the volatility ended with the major averages higher for a change. So we snapped a 5-week losing streak for the Dow and the S&P 500 and the NASDAQ, which was a welcome relief. It was actually some pretty good gains. So we started out the week anyway with a report that China and Pakistan were trying to negotiate a ceasefire and possible end to the Iran war. And that sent the major averages just soaring on Tuesday. I think it was led by the technology sector. In fact, the Philadelphia Semiconductor Index surged 6.24% on Tuesday alone. That's a big move for an index. That was led by a 12.8% jump in shares of Marvell Technology after NVIDIA announced another new partnership and $2 billion investment in the company. And then we nudged a little bit higher on Wednesday. But then everyone was looking for President Trump's speech on Wednesday night to see what he was going to have to say about the war. And it wasn't quite what the market was looking for. So we started to sell off again in the morning and opened up with a big tumble, actually, with surging oil prices on Thursday morning. But then it wasn't quite a capitulation bottom, but it was close. We had the NASDAQ down 470 points, down about 2%. And then we had the Dow Jones down about 668 points. That was a 1.4% drop. And we managed to almost erase completely those losses, and the major averages finished mix. So again, it wasn't quite the capitulation that a lot of technicians would look for because it didn't have the volume that you'd like to see with that, but close. As I mentioned in Friday's newsletter, you don't always have to have a capitulation bottom when you're having something like this. You'd like to see that, but you have to be aware that it doesn't always happen. And you want to notice some of the characteristics of the market when it has a big drop like that and then can still fight back. Now, the technical condition of the market stabilized a little bit last week. That caused us to change the CTI to the -6, but to a neutral market posture. We're going to upgrade probably on this Friday. What has to happen is you're going to need to see the Dow Jones hold intraday above, let's see, what's the number? Hold above 45,057. That was the low on Monday when we had that initial drop. If it holds above that, we'll go to, I think, just a positive +2 and a bullish market posture on Monday. So be aware of that. I kind of think that we probably have seen this bottom on the market we saw on Monday morning. You're seeing some pretty good numbers on the underlying breadth, that type of thing. You saw a big contraction in the number of new lows going forward here. So a lot of more positive type things. We also saw the MarketEdge S&P short range oscillator, the SRO. It was really in negative territory midweek. I think it was like a -7.2. It had a big bounce, kind of an oversold exhaustion type thing, which historically has brought more buyers coming into the market. On the sentiment, we didn't see much of a reaction at all. It looks like the institutional players and retail clients are staying on the sidelines a little bit. I think the NAIM, which is the National Association of Active Investment Managers, it stayed right about 68.4. 4% was 68.5 the week before. It's actually about the lowest that they've been exposed to equities since about May of 2025. So they're sitting on the sidelines, as we've seen several times in March. When we get some positive news of possibly a ceasefire or something like that, or we're in talks, you'll see the market go up 1,000 points. That's when you're seeing the active money managers jumping back in. They've got a lot of cash right now. So at 68% exposure, if we get something like a ceasefire, which they're talking about today, you're going to see that come in, and then probably the following week, you might see the exposure index jump up to maybe 76 or 80, something like that. Then you'll find those numbers in the Friday newsletter. Then you'll know that the active money managers are coming back in a big way. And that's when you want to make sure you're participating in the upside. Okay, market breadth last week, it was good. The advanced decline lines showed some strong accumulation going on underneath the numbers, and that's what you want to see. The NASDAQ had gained 4,306 units on the AD line. The NYSE advanced decline line picked up 2,816 units. So that's good accumulation going on under the surface. That just shows that investors are buying, retail and institutional are picking up stocks on the pullback. They're not dumping everything. It's like they're more inclined to be buying the dips still, although we're still in a series of lower highs and lower lows. So to kind of watch that. But again, I think that we're seeing signs that the worst is over for now, unless, of course, a bomb or something that can change all that. But in general, I think that we're probably seeing things improving over here, and hopefully we can keep building off of what we saw last week. As far as the different technical indicators we saw, we did see some improvement in all of those. We saw MACD, which is a short-term trend type of indicator. That remains bearish. However, we are seeing on the short-term MACD starting to cross into a bullish cross, which means we could start to see another trend going higher. Momentum, it's just trying to recover from some oversold levels, which is or below 20. And that's showing improvement on momentum to the upside. That's, you want to see that could confirm as it crosses over 50. That kind of confirms an uptrend may be starting. So that's good. Stochastics were in the mid-range. They had fallen down almost to single digits here about a week and a half ago, and they were back up to around 35 or 40. So that's good. The VIX, we talk about that once in a while. A lot of times you'll see a big spike when you see these market drops. And this was a little bit different. Not often do you see something go up, the VIX go up in the high 30s, like we've seen the last 2 weeks. You saw the VIX when it crossed 25, it got up to about 37 or so, but it was up a little bit each day. And then now we're starting to see it coming down again. And we saw it, I think, see today, it ended up at 23.87. So it did fall back below 25, which is good. Keep an eye on that. That's telling you that the active traders aren't quite as worried about steeper sell-off than what we've seen so far. So that's another sign that shows some stabilization in the market, which you want to see. Now, we are still below the key moving average resistance levels. We're still below the 200-day moving average on the S&P 500, the NASDAQ, and the Dow. S&P 500 also, for some reason, keeps struggling around 6,600. That's not really a moving average resistance level, but for some reason it gets above there a few points and then it stalls out and comes below it. We'll see how we go. You want to keep an eye on that too. Crosses that, it'll be working its way then towards the 200-day moving average. We did see some Fibonacci retracement levels tested. The S&P 500, NASDAQ, and the small cap Russell 2000 have retraced about 38.2% of the February to March sell-off. If we break through that, the next point of resistance would be the 50% Fibonacci retracement level. We did see that on the Philadelphia Semiconductor Index, and then we saw the Dow Jones Transportation Index get up and recover 61.8%. So the fact that the stocks and the transports and even the Russell 2000, which I often refer to as the secondary indexes, the fact that they're outperforming is showing positive convergence, which you will also look for at a market bottom. In other words, you want those indexes to lead the market higher or lower. And the fact that they're actually still positive for the year, but the fact that we're seeing that positive divergence coming in those indexes is also telling you that more than likely the bottom is in. And this week coming forward, we're going to have some pretty important numbers that you want to watch. Today we had the ISM PMI Purchasing Managers for Services Index come in at around 54.9. That was down just a hair, nothing real big, but prices paid showed an increase, which is inflationary. Last week, we also saw some of the jobs numbers come in. ADP had a pretty good jobs report. February retail sales were strong. On Friday, while we were out, while the market was closed, the BLS, the government's job report, came out, and the expectations for that were only for 59,000 new payrolls to be added, but it came in at 178,000 new payrolls, which is a big beat. We also saw the unemployment rate fall down to 4.3% from 4.4. So that's great. But again, it does show that the odds of a rate cut going forward are pretty much nil. I think we're lucky to get a 50-50 chance out to December. So don't expect that. Also this week, we're going to see some key inflationary data coming out. On Thursday, we get the PCE index will come out, and that's pretty much what the Feds look at for inflation. I think right now they're looking for about a 2.8% year over year increase. That would match January. And then core PCE is looking for about a 3% rise and maybe 1/10 percentage points less than previously. I don't think it's going to be enough to move the rates too much unless we come in because of gas or something like that. We get a big jump. From what I understand, the Fed is going to try to minimize the gasoline component of some of these inflation things, just figuring that it's going to be a short-term type of thing. They're hoping anyway, and we'll have to see how that comes in. But anyway, those will be the key things that we're going to look at. We also will, believe it or not, we're back the start of earnings season. And I think it's Delta comes out on Wednesday with the first quarter earnings report. That's going to be an interesting one because I imagine you're going to see some of these transportation firms talk about the demand is good, it's strong, people are still traveling, but their costs are going to be going up. And I think they'll be talking mostly about what's going to happen here going forward with their fuel costs. I know for the airlines, fuel has almost doubled from what they were February and January at. So that'll be something to keep an eye on. And then the week after, we're going to start getting more of the big money center banks coming out again. We'll see how that goes and what they're projecting, if the war is going to slow things down or not. Right now, as far as earnings estimates go, according to FactSet, we're still seeing healthy earnings. Some of them are still going up. I think they're looking for an increase of about 13% for the year. So that's a market that fundamentally we still look good. We're also going to get GDP this week. People will see if the war is slowing that down. And then I think on Friday, we'll also get the CPI, which is another inflation report. The core CPI, I think they're looking for to rise 2.7%, which before the previous month, it was 2.5%. So we're going to start to see a little bit of inflation tick up from the Iran war. You don't want to see too big of a spike, but you also want to look at the other components when you read about it to see if the food and some of the other costs that we see being passed on to the consumer, if they're leveling out rather than moving up with the gas prices. So it's going to be an interesting week. Again, over the weekend, we heard Trump was going to blow up Iran, which he always threatening to do something. But then today, we're actually getting the market heading higher because of another report that Iran and the United States are looking at a ceasefire proposal from Pakistan and China. So that's causing markets to move higher today. But I imagine it's still going to be a volatile type session. I think if we pick up the bombing went Tuesday night or something, it'll just add to more volatility. So you will still want to be patient, be cautious. I know just in my own personal dealings, I've bought some things that I like while we're down here. Moved down about 10%. A few things that have corrected more than 10% that I like, I've picked up and I'm profitable on them. And so I think if you have a list of stuff that you want to buy, we've talked about it before, where you maybe put a buy order in somewhere around some of the key resistance levels, it might be a good time to do that. Because again, if we do have a ceasefire, I imagine you're going to see a big spike in the major averages, and you don't want to just be left on the sidelines and say, I missed it. That was the biggest correction we've had in the year, and I was on the sidelines and missed it. So that's about it for today. Again, going to be another week with a lot of stuff coming out, and we'll see how it goes from there.
Very good. Thank you, David. If you have questions for David or anyone else on the MarketEdge team, feel free to email us at support@marketedge.com or drop us a comment if you're watching on YouTube. If you'd like to get technical analysis on over 5,000 stocks and ETFs, check out marketedge.com. Your first 2 weeks are free. All right, that's it for this week. Please like and subscribe, and we'll catch you next week.